Good day, ladies and gentlemen, out of our studios here in Munich. Commodity TV, Mark Learmonth is here, the CFO from Caledonia Mining. And yeah, we want to get an update about the company. Mark, good morning. Happy to have you here.
Morning.
Caledonia Mining, you are working in Zimbabwe, very successful gold production. I think we spoke something around Mines and Money last time.
Yep.
So a lot of good things happened. Maybe you can give us a little bit of a roundup.
Yeah, well, what's happening is we're very much delivering on the plan that we outlined in November 2014. Mm-hmm. So what we said in November 2014 is we said we're going to do some underground infrastructure works so that we can increase tonnage. We're going to finish off a subvertical shaft so we can get access to some material deeper. Mm-hmm. We've done both of those. And hey, what do you know? The tonnage has gone up, production's gone up, production's continue to go up, and the costs have come down. Mm-hmm. So very much quarter on quarter, we are exactly where we thought we would be in terms of the increasing production profile, the falling costs, mm-hmm. and helped by a rising gold price. Mm-hmm. And so that's put us in a position where, you know, we now can see as we move forwards into quarter 3, quarter 4, then into 2017, 2018, 2019, and sorry to be boring, 2020, mm-hmm. continuing production increases, continuing good cost control, and turbocharged cash generation. So it's a great position to be in.
Fantastic. How much money have you spent so far, and how much more you have to spend?
We spent $18 million last year in 2015. 2015 was a tough year, hey? So production was 42,000 ounces, which is again what we expected, but at that production level our costs are not as low as they are now. Mm-hmm. The gold price was lower than we expected. So last year we spent $18 million. We had to dip into treasury. So we started the year with about 20 million, and by the end of last year we got down to 10. We had 10 at the end of June 2016, mm-hmm. and now the cash is beginning to increase. Mm-hmm. You know, already the cash, and we're now in sort of mid-September. Already the cash is beginning to increase, and it will continue to increase now for the next several years. Mm-hmm.
But you don't need to raise money for that. You pay everything out of the cash
Absolutely.
flow, and you don't
Absolutely.
have any big debt, right?
Not at all. No.
Yeah,
No.
yeah.
No. We've put we just put a $3 million structured debt facility, a term debt facility. Mm-hmm. into Zimbabwe, simply because Zimbabwe now generates so much cash. It just makes their balance sheet more efficient, gives some business to a local bank, which is always nice to do, and it means, you know what, it means we can take some more money out of Zimbabwe and pay dividends to ourselves and to the local shareholders. So that's that, and that debt, we could repay that debt in the twinkling of an eye. That's not a problem.
Exactly.
Not a problem at all.
Yeah, great. Dividends, that's the key word. I mean, I love it. You know that.
Yeah,
I'm a shareholder of the company, of course. And you are paying quarterly dividend, but you also increased the dividend substantially in July, right?
Yeah, we've paid quarterly dividends for several years now. Then we do that because, you know, given the fact that we're in what people perceive to be a high-risk jurisdiction, we do it so every quarter. They get a reminder that we're still there. You know, we're still producing, we're still profitable, we're still making money, and here's a dividend to prove it. So we've done a couple of things. Earlier on this year, in March, we moved the company from Canada to Jersey in the Channel Islands. And what that means is that for non-Canadian investors such as us, whereas previously our dividends suffered Canadian withholding tax, you know, which meant that if we declared, you know, for every dollar we declared, you get 85 cents or even 75 cents. You know, having moved to Jersey now, if we declare $1 and pay $1, you get $1. So for the non-Canadian shareholders, that was already a bit of an increase in the dividend they received. And then in the middle of the year, in July, we increased the dividend from 1 1/8 US cents a share per quarter to 1 3/8. So that's a 22% increase. So now we're paying 1 3/8 every quarter. The next dividend's paid at the end of October, then at the end of January. The dividend costs us just less than $3 million a year. We've got 10 in the bank. You know, there's more coming in every month, every week there's more money coming in. So we do have the capacity as we move forwards to begin to consider perhaps increasing the dividend, and also begin now to explore and evaluate further investment opportunities to further boost our cash generation in the future. So it's a great position to be in.
Will you, when you say further investment opportunities, will that be also in Zimbabwe, or maybe, let's put it that way, also on the continent Africa?
Look, initially, the sweet spot would be clearly to invest in our own business, because we own it. We don't need to pay anybody else for it. Yeah. And we do have opportunities in our business, which we're evaluating. We will look at other things in Zimbabwe. We've got a good relationship with the government, a good, transparent, honest working relationship with government. We've got the infrastructure on the ground. We've proven we can operate there. We know how it works. And we think asset prices are relatively cheap. in Zimbabwe. So we would look in Zimbabwe. Otherwise, we'd look in English-speaking Africa. And the reason we don't want to go to places like the French-speaking Africa is you've got to be able to talk across to government. And my French ain't that good, and you've got to be in a position where you can sit across the table from a government minister and have a direct conversation with nothing lost in translation.
That's important.
So that really restricts you to English-speaking South Africa. We wouldn't touch South Africa at all, so you can carve out South Africa. So that really limits us to Botswana, Namibia, Tanzania. And if you go much further north, then the risk is you start stretching the management team too far. And frankly, West Africa is closer to Munich than it is to Johannesburg. So, that kind of limits us to where we're going to be. We're not going to start running off and doing stuff in Mexico or Brazil because we just don't have the skill set to do that. We just don't. And as a shareholder, if I was an independent third-party shareholder, if we started running off and spending money in a new jurisdiction, I'd get a bit nervous. Yeah.
That's right. I would be nervous too, honestly.
And I would hate you to be nervous.
No, don't do that. You were now at the 750 level in the mine down, or let's say in the ore body down, and now you get access below to 1,000 meters depth. How deep you think you can go? First question, and the second question: what is on the surface around the mine? Are there also possibilities?
Yeah. So what we've done is the mine's been running for 100 years, and until earlier on this year, the bottom level of operation, as you say, was 750 meters below surface. And we're pretty much beginning to run out, pretty much beginning to run out of material above 750, so we have to go deeper. And the good thing about going deeper is that typically the grade tends to go up. All right? So what we've done is we've finished off a subvertical shaft, which we finished off earlier this year. And then something we've been a bit quiet about, we've put in what we call a decline, which is just a tunnel that slopes at 9 degrees and it goes round in a circle and takes you down to town. We're taking it down sort of 30 meters. And that also gives us additional access at deeper levels. People historically haven't done decline developments in Zimbabwe. And everyone said it couldn't be done, it couldn't be done. We've actually found it's very cheap, it's very quick, and it works very nicely. So we are now getting material from below 750 as part of the Central Shaft project, which will be finished and fully operational by mid-2018. By that point, all of our production will be coming from that layer from 750 meters down to 1,000 meters. That will keep us busy for a decade or so. And then as we're getting into that layer, then we'll start exploring the next layer down from 1,000 to 1,250, and then from 1,250 to 1,500. So we're absolutely confident that this mine will continue in production well after I'm gone. And the mine right next door to us, they're already operating down to 1,500 meters below surface, so twice our depth. But critically, because the ores that we exploit are so old, they're not hot, they're quite cool. Now, for most mines, as you go deeper, it gets hotter. But certainly, as when we're down at 1,500 meters, certainly the mine next door, you don't need to have these expensive cooling systems. So we're not expecting, as we go deeper, we're not expecting to see any significant increase in our cost for having to introduce cooling systems.
Fantastic. What's about surface exploration? I mean, around
surface exploration, we've got the mine footprint, which is about a 3 kilometer area, and we have about 18 little properties dotted around the place, which we're now beginning to turn our attention to. So we've spent some time looking at 2. They're kind of okay, but perhaps we can find better. So we're aware of we've got 2 more that we're just about to start turning drills on and start doing some work on as well. So that hopefully over the course of the coming years will add some extra impetus to our production. But frankly, that's like icing on the cake, really. I mean, my sense is the market needs to, and they're getting there, needs to begin to understand what we're doing on the core footprint. Taking this mine from 42,000 ounces last year to 50 this year, 60, 65 next year, up to 80. Begin to understand that, begin to buy the story, begin to understand the very powerful effect that has on earnings and cash generation. And once they've done that, then we can start feeding them extra icing on the cake in terms of the extra. They've got to buy the core story first, yeah? It's like I used to tell my kids, they've got to eat their broccoli before they can have the ice cream.
Okay, great, fantastic. Well, Mark, thank you very much for that. That was a great update. And keep on the dividends paying and rising for sure. And we going to see us latest next year in front of a camera, I would say.
Absolutely. Thank you very much.
Thank you very
Thank you.
much. Ladies and gentlemen, it was Mark Learmonth, the CFO from Caledonia Mining. And yeah, you heard it. The company delivered with their revised investment plan, and everything is going quite well, from 42,000 ounces last year now to 50,000 ounces. Next year they want to go already above the 60,000 ounces, and the company raised the dividend by 22% in July, which is great for the shareholders and also for new shareholders for sure, because dividend, this is the new interest in a negative interest world. And I'm very confident that they will stay with the dividend and also will rise it as gold will rise further and their production rises. So the costs go down. That's the best you really can have and achieve. And so check out the company. Thanks for watching us. Bye bye from Munich.